Greetings everyone, welcome aboard. My name is Joseph James from theschooloftrade.com, and in today's video I want to talk more about candlestick patterns. Now guys, don't forget, right below this video right now is a link that will take you right to our blog. Our blog at sidewaysmarkets.com, right? Or click the link right below the video that will take you guys to our blog. On our blog we have live trade calls, a free 3-week trial, and of course a live trade room. You guys can come out and listen and watch our live trades every day, Monday through Friday. So candlestick patterns, guys. We get all kinds of questions from our guests and our members about candlestick patterns, and I really want to make sure I did a well-rounded video for you guys here so you could understand how we use them, what they are, why we don't use some patterns, and what some frequently made mistakes are among new traders. So first of all, guys, remember, since the beginning of time, the trades that we take, right, the markets we trade have been governed by human beings, right? Human nature, right, overcomes everything that we do in the markets. All right, guys, now traders, right, you and I, human beings, okay, we trade as an act or as a result of fear, greed, ignorance, and hope, right? I'm greedy. I want to make more money, right? I'm fearful. I don't want to lose any more money, right? Ignorance, not knowing what's going on around me, right? And hope, right? How many times have I pushed my stop back? How many times have I tightened my target? All based upon that 4-letter word, H-O-P-E, right? Hope is like, right, is almost like cement boots for a trader, right? It'll put you right to the bottom of the ocean, and it will only take a very little bit of time before you're drowning, right, in your losses. All right, guys, now this is why numerical formations or candlestick patterns, this is why they reoccur. The reason why these candlestick patterns reoccur over and over again is because human beings can never, right? They can't not become human beings. And human beings, they react upon greed, fear, ignorance, and hope. So price patterns, right? These remind us, okay, that we can use the past to predict the future, right? These candlestick patterns are being repeated. Okay, they're reoccurring over and over again with very slight variations, and they have what we call a statistical reliability. And that means 83% of the time, right, they work every time, right? Now, guys, this again is because the markets are driven by humans, and human nature never changes. Guys, your grandparents, your great-grandparents had fear, greed, ignorance, and hope, just like their great-great-great-grandkids sitting here today trading the same exact markets. So guys, remember, before we talk about candlestick patterns, let's take a step back real quick and realize that there's a great amount of history on our side. And that history is supported by, you guessed it, us, right? Human beings driving that human nature of fear and greed. Now, enough about the background of why this all works, right? What are candlestick patterns? Well, they come from Japan. Japanese candlesticks have been used in the 17th century in technical analysis. These have been one of the earliest ways to read price charts, right? Day traders have been doing this for centuries, guys. So it's a visual recognition of chart patterns. And guys, although probably hundreds of thousands of these exist, we're going to focus on only a select few. And guys, that's a lot. That's very typical of day traders. We have all these options to choose from, but at the end of the day, right, we're going to choose only a select few that really work the best. Now, there are two main ways that I use candlestick patterns, guys. You want to remember this. Out of all the options of using candlestick patterns, right, there are probably hundreds of ways you could use candlestick patterns. There's two ways that I use them. The first way is to define market sentiment, right? Candlestick patterns tell us what the market's thinking. And the second is to enter a trade. Now, this could also be to exit a trade, right? Candlestick patterns. But guys, it all boils down to that simple fact, market sentiment, right? Candlestick patterns, reading the time and sales window, tape reading, right? The speed of the market. Guys, these are all going to be different ways to define market sentiment. Okay, so candlestick patterns I'm going to use to define market sentiment. Usually the most common way of using it is to define that market sentiment. All right, let's look at a little bit in depth on some of the most important candlestick patterns you guys are going to learn here. Now, like I said, guys, we're going to cover a lot more of this. All right, there's a lot of patterns out there, but I want to go over what are the basics here so you can get the firm foundation of knowledge, and then we'll build on top of that foundation. Okay, so candlestick patterns. When a bar close is higher than the open, okay, the body of the candle is white or green, it's considered bullish. Okay, so when the high of the candle is higher than the open, it's going to be a bullish candle. Now, when the low of the candle, right, is below the open of the candle, it's going to be a bearish candle. We'll color those red. All right, now the body of the candle contains the price action between, right, the top and the bottom, okay, including the wick, right? So you got the wick, right, the long thin, right, the wick, and then of course you got the body, right? The body of the candle is the price action between the open and the close of the individual candle. All right, let's keep moving. Now, a large bodied candle is going to indicate strong price action. Okay, so on the left side here, there's your long, right, there's your long bodied candle. That's strong price action. Buyers pushing it up, sellers pushing it back down. And then of course a small bodied candle, right, that will show you weak price action. Right? Weak price action meaning there wasn't much buyers pushing up and there wasn't many sellers pushing down. Now the tail of the candlestick, right? Now the tail of the candlestick, this shows prices that occurred above or below the open or the close of the candle. Right? So you've got the open and the close of the candle. The wick, right, or I should say the tail, right, is the difference between the open and the close. Now, of course, remember guys, tails are going to give us a lot of information about the market. Okay, tails are also, right, we look very closely at tails because they're also considered, right, the extremes of the candle. Right? So of course, you've got your candle wick, you got your body, right? There's your wick, right? So my extreme low of the candle would be down here. My extreme high of the candle is up here. So when I break the low, right, that might be a trade entry. When I break the low, that may tell me now to stay away from a long trade, right? When I break the low or the high of the candle. Okay, so often a tail will show the signs of a change in trend. Right? So when I break above the upper tail here, I'm now trending up. When I break below, I'm trending down. Now guys, candles without tails, those indicate strong continuation of the trend. So oftentimes we'll see a candlestick that will look like this. Right? No bottom tail, right? Just the top tail. And so of course there's the low of that candle. We'll wait to take the break below that candle for a short trade. Okay, so candles without tails indicate a strong continuation of the short-term trend. Let's keep going. Let's keep going. Now, what about bottom tails? Right? Bottom tails, right? They, of course, indicate that lower prices did not hold. Right? So a bottom tail here on the left, it tells me that the sellers pushed down, they couldn't get it done, and the buyers came in and popped it right back up. Right? And that's why you can tell here, right, for this long tail, right? The buyers pushed it right back up. Same thing is true on the opposite side here, right? There's that long tail to the upside here. You can see the sellers pushed it down, right? But only after the buyers had pushed it up, right? Because remember, guys, in order to get that tail there, right, you've got to, of course, have the price action to the upside. Okay, so at one time, this was a very big-bodied candlestick right here. But you can see the sellers pushed it right back down, giving it this long upward tail. Okay, so top tails indicate the buyers have lost momentum. Okay, top and bottom tails are seen most frequently at the high of day or the low of day. All right, so here's my high of day overhead. Right, there's my high of day. You're going to see this happen all the time. Right, this big top tail to my candlestick. And so what that tells me is, that tells me the buyers pushed it above the high of day. They couldn't get it happening to the upside, so they gave up. Sellers brought it right back down. Right? Great example there of how to use top and bottom tails. Again, look for those at the high and the low of the day. Let's take a look now. What bearish and bullish patterns? Okay, so now some patterns may be bullish and some patterns might be bearish. Now, of course, a bull, right? We'll talk about the bull right? The bull flag and the bull pennant. Okay, now here's an example of a bull flag. We're going to have a nice strong move up, and then we'll begin to go and consolidate a little bit here into that high, right? And there's your flag pattern. See that? There's your flag. Okay, a bearish flag would be a strong move down. We then chop around, right? There's your bearish flag. Notice how lower highs. Right, guys? This is also called a wedge, right? A flag pattern, right? Or a pennant pattern. All right, guys? So it's continuation pattern again, right? The bullish, right? The bullish pennant here, strong move up,